Hey guys, Eric here, Mr. Fired Up Wealth. Today I'm going to bring you my completely unscripted, candid thoughts on what I think will happen to the stock market in 2021. I'm going to show you some analyst opinions as well, some predictions for the S&P 500. You definitely want to check out this video. Stay tuned. All right, guys, what's up? Eric here, Mr. Fired Up Wealth. Let's do something a little bit crazy, a little bit off the norm for the channel, just for fun. Now, of course, I'm not a fortune teller. I'm not a genie. I can't read the future, but this is for fun, for entertainment purposes only. Let's just look at some possibilities. Let's look at some data and see what could happen potentially with the market in 2021. And again, if you're talking about the market, usually it's the S&P 500. I generally track the NASDAQ, but this is just for fun, and we're going to talk mostly about where we think the S&P 500 is going to be in 1 year in 2021. So let's get it kicked off. If you haven't subscribed before, please do. Please subscribe if you're not a subscriber already. Please hit like and comment if you enjoy this video. And I encourage you to check out the channel. I actually have patrons I talk to on a daily basis that ask me, hey, what do you think of this stock? I'm like, well, here's a video I did on it, a month ago. And so a lot of times there's videos out there that people just don't see. So I encourage you to go to Fired Up Wealth channel, look through all the different videos. There's lots of great videos that have been done that just haven't really been viewed a whole lot of times. So take a look at that. 2021 stock market predictions. What's going to happen? What should you do with your money? Well, let's take a look. So this is from a CNBC article, and they basically did a survey for a bunch of analysts. A majority of the analysts surveyed expect between 8 and 22% upside for the S&P 500 in 2021. That's a big range, 8 to 22%. But for the most part, people are very bullish on the market right now. In fact, the sentiment index is the highest it's been in a really long time. Today is actually the launch of the Airbnb Ipo, and it's actually trading at $142 a share right now. It's something around $100 billion valuation, which is larger than all of the hotel chains. That's a lot of money. So maybe it's justified. I don't know. It seems a little bit rich to me. I did skip that one. I was thinking, maybe $100, which I knew was expensive, that I might dip my toe in that and dollar cost average, but it opened way too high for me. So I passed on that. We've had a crazy year for IPOs, for SPACs. Just been an insane run. And anybody in tech and growth, anybody that's buying stocks from this channel, you've probably done pretty well in your portfolio and you're pretty happy. Now the question always is, what do I do? Do I continue to hold these stocks? Are you going to shave profits? What are you going to do? So I'm going to get to that in a few minutes. I'll give you my opinions on some of that. Let's go through this. I think it's good information. So 14 out of 20 analysts said they are cautiously optimistic for the new year. If you look at this other stat here, 13 out of 20 strategists believe the US dollar weakness will continue in 2021. Why is that important? Well, if you're a multinational company, say Apple's a great example where they're doing business in a lot of different countries, a lot of different currencies. If the dollar is weak, it actually helps their bottom line. So it actually will help a multinational company like an Apple, probably like a Starbucks. There's some great examples there, and of course many other companies in that boat. 12 out of 20 of the market strategists from major U.S.-based financial institutions who were polled predicted the S&P would rise between 4,000 and 4,500 next year. Today is December 10th. It's a December 10th of 2020, and we're about an hour and a half from closing bell, and the S&P 500 is at 3660 right now. So they're saying 4,000 to 4,500, which anywhere from 8 to 22%. It's a pretty significant jump. So is everybody just insane? Are we all crazy? Let's take a deeper look and see. So if you look at a couple of the quotes on this article from CNBC, and I left you a link. I'll leave you a link in the description as well, so you can take a look at the source. And I'm going to give you my opinions, just completely unscripted here in a few minutes. So this US-based market strategist, without a T apparently, because, looks like a typo. I see 15% upside as the world comes back online. Well, a lot of people would argue that's more of the rebound type stocks, the value type stocks. You're hearing a lot of chatter on that right now. I'll get to it in a second. We believe that as we head into 2021, The broader story will continue to be the true reopening of the economy in the US and globally, driven by the distribution of vaccines and an increase in global economic activity. This time it's a strategist with a T, so that's good. No typo there. What else? So in the scenario that we do see growth in earnings rebound in 2021, so this is saying if we see growth in earnings rebound in 2021, which most people would argue they think that that will happen. While rates remain low and fiscal stimulus is added to the system, this is a favorable backdrop for risk assets broadly, the analyst continued. Another respondent said, we think low rates combined with a rebound in S&P 500 earnings will cause stocks to hit new highs in 2021. I do tend to agree. Cautious optimism. Despite the ambitious targets for the index, among many of those polled by CNBC, even some of the optimistic respondents said they'll closely watch how the pandemic is managed and the steps that governments take to boost the economy. So stimulus is still going to be important to this story. I see a 15% upside as the world comes back online. Central banks around the globe pumped in so much liquidity to help stem the market collapse that more normalized market conditions give a reason for the next leg in the bull run, said an analyst who is also watching for delays in U.S. stimulus that's been happening for, it seems like, months. Next potential waves of COVID-19 that's been getting worse by the day, and potential vaccine shortfalls. Okay, so what are my thoughts? Well, I'll just give you my total unscripted, candid thoughts of what I think is going to happen with the market. Again, I don't have a crystal ball. I'll tell you what I'm doing with my money. I'll tell you what my gut says, what my research tells me. Obviously, I follow the market very closely. This is now my full-time gig. I resigned from my corporate gig about 3 weeks ago, so I'm doing some active trading, and I also manage a long-term growth portfolio. And you can follow that portfolio and discuss the different stocks that I'm buying in Discord by joining Patreon. But I wanted to do this video for YouTube. I have morning live streams for Patreon, and I've given my thoughts to them, and I thought it'd be nice just to share it with everybody else and tell you what's kind of on my brain here for the rest of this year as well as 2021. So let's start first with the end of 2020. So 2020, obviously it's been a crazy year. It rebounded a lot harder than most people probably would have thought. The other thing you have to remember, though, for one, stimulus. We've had, a record amount of trillions of dollars pumped into the economy, which not only increases the GDP from the U.S. perspective, but also the global GDP. I've seen statistics all over from economists from, another $1.8 trillion is equivalent to around 2% global GDP. I've seen even numbers where $1 trillion was equivalent to 1.5% to 2% of the global GDP. And that's just talking U.S. stimulus. And then you've got other countries doing stimulus as well. So it is a really big deal, and it does matter. The interest rates obviously do matter as well. Lower interest rates are going to boost the economy in several areas, such as housing. Now, what you're starting to see with housing is that the prices of homes are becoming more expensive, and it's kind of counteracting the low interest rates. So what that causes is a little bit of a potential bubble at some point. Maybe we're not there, but maybe we're getting close to it, especially in certain areas, like maybe in California or New York, where the average person can't afford a mortgage. And now, say you can afford a mortgage, but now the rates go up, and now you go to sell, you're going to have less people that can actually afford to pay the monthly payment. So your market has actually shrunk, and now it's harder to sell. It's about supply and demand. Right now, we have more demand than supply in a lot of cases. If interest rates go up, you're going to see the opposite of that happen, and that is a huge risk for the economy. It's something that we saw, not exactly the same situation, but back in 2008 with the financial crisis, 2008, 2009. That was obviously, there's a lot of stuff going on with mortgages and things like that, and people basically borrowing money that they couldn't afford and not putting down payments in, and having adjustable rate mortgages, things like that. But it's still the same concept. When your adjustable rate mortgage went up back in 2008, 2009, now you can no longer afford the payment. and it's obviously going to be harder for people to buy the house if the rates are going up. It's kind of the same concept in a different sense, but you get the idea. So you've got that working behind the scenes with housing, and then you've got things like, we've got a new president coming in potentially. It looks that way, at least, that Biden's going to be taking over here in January. So if that's a smooth transition, that's one of the risks too. That's a geopolitical risk, a macroeconomic risk, that if there's more drama with the election, that there could be issues. But saying that goes smoothly, most people would agree that a Biden administration would probably be more dovish to China. Now, a lot of the volatility and market fluctuations we've seen over the past several years has been from China trade tensions. And if that settles down, of course, you could see, a massive rally in a lot of these Chinese stocks, especially in the tech names. There is some poor sentiment with U.S. investors, especially not wanting to invest in Chinese stocks. You also have, the U.S. government actually making parts of the population not being able to buy certain stocks and actually putting bans on specific stocks. But if you see that nature kind of, lighten up a little bit, more of a dovish, that's going to help. If interest rates continue to stay low, that's going to help. More stimulus is going to help. So you could argue that a Democratic Party is going to, offer more stimulus. Now, the other risk to that is potentially raising taxes, especially on trades for U.S. investors. Some would argue that since we're divided, that a lot of stuff will not actually get approved. There's a whole lot of what ifs when you're looking at what could potentially happen from a macroeconomic perspective. From a sentiment perspective, which is really important, the market is very bullish, and we have a lot of retail investors that maybe never invested before 2020. And if they continue to invest, that does change the market, especially in specific areas, like with SPACs and speculative plays and high flyer growth names. A lot of the names that I even buy on the cloud side, the SaaS side, would be included in some of those kind of cult stocks, the Robinhood type trader stocks, the retail traders. So I invest in kind of a variety. I've got some boring blue chips stocks. I've got a lot of the growth names, the Datadogs, the CrowdStrikes, the DraftKings, the Teladocs, and so on. But then I also have, a few ETFs mixed in. I actually have decreased some of my ETF exposure. But what I think is going to happen, I think we'll probably see, a little bit of volatility. If you look at historically, I think over the past, 20 years or something, it's something like 18 out of 20 times the market tends to rally, the Santa Claus rally, from around the 16th of December until after Christmas, December 25th. So you probably see a little bit of spike in that. You typically see a lot of the retailers tend to spike up in anticipation for, the quarterly earnings that are going to be, better because of the holiday shopping and things like that. It is a very unique year, though. I mean, obviously, a lot more people are buying online, so certain companies will benefit more than others. I personally think Amazon, at $3,000, that it's probably going to be worth more than that next year. I could see Amazon easily being a $5,000 stock in 2 years, and that's my largest holding, and it's kind of been sitting flat. It's literally flat today, trading just over 3,000, 3,100, something like that. Stocks like Apple, even though expensive, can continue to do well in 2021. I've done a video recently on the top DGIF stocks, includes Apple and a couple others, so take a look at that and watch that video. But I do think that we'll probably have, a little bit of a pop. Maybe we have some volatility, with tax loss harvesting towards the end of the year. I do predict, my gut tells me we'll probably have a little bit of a rally early, January, February. I do think, the whole sell in May and go away. They say sell in May and go away. A lot of times you get a little bit of a rally, January, February, March, maybe April, when we start to sell off. And then people typically sell off, kind of disappear for a while. The trading volumes go lower for the summertime, and then it kind of picks up after summer because, typically with kids schooling and stuff, a lot of people did vacations. Now, I can't really tell you what's going to happen next year because it's not a normal year. And is it ever going to go back to normal 100%? Is it going to be some kind of hybrid in between? I think probably so. And I think that's also why you continue to see some of these work from anywhere names continue to do well because the digital transformation is real. We took 5 years of growth and crammed it into 5 months for a lot of these companies. When you think of companies like CrowdStrike and Zscaler and a lot of these names. And I do think that even though there could be some churn in those names, there could be, secular rotations going from growth to value. And that's happened a couple of times this year where stuff sells off, value pops, and then it goes right back to growth. I do think that a lot of the names that I invest in have some volatility. And I tell this to the Patreon team all the time, in Discord, that there's a chance that if you're investing in a high flyer like a Fastly that went up 300-400%, and in fact, Fastly was $11 in March and it's 100. So it's up 1,000% in less, in 9 months. That's insane. So that's why I take profits on some of those that go parabolic. But if you've got something like that, that has gone up that much, when it just went from 125 Fastly to maybe 60 in the 60s or something like that, losing like half of its value, that's not really that surprising to me. But some people that are new to the market, they want to, go chase CrowdStrike now at 177. And maybe, maybe that's a good move and it just keeps going up from there. And I do think CrowdStrike will be worth a lot more than $170 with time. But I would rather buy something on a pullback that's closer to a 200-day moving average or at least a 100-day moving average versus buying it when it's, way elevated and has so much risk where it can come back down to those moving averages. So I like to use technicals for entries and exits. If you're following Discord, you'll see how I buy. I buy strategically on those pullbacks. I think we will have pullbacks. I think you're going to see, some pullbacks in some of these high flyer names. People will take profit maybe even before the end of this year. So you could see some of those names sell off a little bit, but I do think if you're holding them long term, if you're buying the right stocks and they're quality names, I think they're going to be worth more money in 2-3 years. I don't ever buy anything with the intention of holding it forever. I buy a stock and I evaluate it constantly every earnings. So 4 times a year, because there's 4 different quarters, and then I follow each stock, any kind of news that I see. I'm constantly keeping an eye on all the stocks I own. So if the story changes, sometimes I will sell. If something goes parabolic like Appian did, Appian went up 200% in a month. I sold my initial position and I let the rest run. And that's what I like to do as a disciplined investor. And I think it's a good idea. You have to do what you think is best with your money, of course. But so my prediction for the stock market next year, the NASDAQ right now is 12,380. It's really hard to guess what the NASDAQ's going to do, but the whole video here, we're talking really S&P 500. So if I want to compare to those other analysts, the S&P 500 right now is 3663. There's, an hour and 15 minutes left in a trading day on a Thursday. I think that if you go 365 days in the future and go towards the mid, December of 2021, I think we probably see something like 4,200 on the S&P. It could even be higher than that. And it could obviously be a lot lower than that. We just literally came from 2350 in March. So to go from 2350 to, to 4250, that's pretty much insane, right? So the reality is this: the stock market is expensive right here at 3,600. For a lot of people, it's hard to be adding stocks. Now, for someone like me, I'm in a really good position because the majority of my portfolio is profits. And so I'm not nearly as worried as if I'm putting brand new money to work. And that's why I like dollar cost averaging. So I can understand completely if you're new to investing where it's really hard. How do I know when to buy CrowdStrike now? Eric said 125 was a good price. Well, I didn't watch the video until later, and now today it's $170. Personally, what I do is I track, 100 different stocks, and I wait for my favorite stocks to go on sale. If you're looking at individual names right now, look at like a JFrog. JFrog is back to $68, not much higher, pretty much in the same range as it was in its IPO. Could it continue to go lower? Sure. But if Airbnb is $146, you scratch your head. It's like, well, okay. A lot of people are just buying some of these IPOs because they think they're going to go higher and don't really know how to evaluate stocks. Just basically buy a stock because you think it's going to go higher. And that's worked really well this year. And maybe it'll continue to work, but at least be aware that historically that's not how it's been, right? So if I'm looking at a CrowdStrike, I probably wait for some sort of pullback, and maybe I have to stretch and pay 150 bucks next time because a stock like that makes higher highs and higher lows. And you know, I can help you chart it out. If you know, join Patreon, I'll show you how to chart it out, where you can draw channels and actually say, well, here's where the stock's probably going to go now. So if you're looking at a CrowdStrike, this is probably where you're going to have to end up, you know, looking, and you're using pivot points and things like that to try to estimate a good entry point. And that's what you're going to have to do. You have to be really strategic. You have to use, you know, your head, be smart. Don't buy everything all at once, kind of dollar cost average in. Be strategic when you're buying certain names and what have you. But I personally will probably, you know, trim some of my positions next year. Certain ones that I've run a lot. I'm still a long-term investor, and I'm going to hold most of my names long-term. So I'm going to be selective. But you know, I do have some plans next year to raise some cash, maybe pay off my mortgage. Now that I'm essentially self-employed, it'd be nice to kind of, you know, sell off some of that. But I mean, I'm talking about, you know, my portfolio has gone up a lot this year, and you look at March lows and it's kind of mind-boggling because, you know, I had some high flyers that got hit really hard. I repositioned, I had some cash, I bought stuff. I also repositioned some of the things that I didn't think would recover as well. I took losses on that, you know, tax loss harvest some of those losses, put them into stocks like Zscaler and Zillow Group, and, you know, those kind of names that were going to benefit from, you know, the whole digital revolution and the work from anywhere economy. And we nailed it. I mean, if you follow the videos back to March and April, it was like, here are the stocks that are going to do well. Here's what I'm buying. Here's what I'm selling. I'm repositioning capital, even if it's at a loss, because I might take a 20% loss on Macy's, but I might gain 300% by investing in Fastly when it's at $11. And then, oh, I guess it's, you know, I think Fastly was at 20, but you get the picture. 20 to 100, that's a 500% gain since March. That's pretty incredible. So, but hey, thanks for watching. Please subscribe if you haven't. Check out Facebook. We've got a free group there. I'm on Twitter. I'm on Instagram. I've got Patreon. You can join. There's different groups. I've got a masterclass on there. If you join the Elite or VIP, I've got a VIP where you actually can do one-on-one calls with me for mentoring. If you have questions, drop a comment. Happy to answer it. I know it can be confusing with all different platforms. So thanks for watching. Hope you have a great rest of your day. Take care.